So welcome to the interview today. We have a very special guest, John Mauldin, who is one of the most influential economists and writers, and he's a well-known financial speaker and macro thinker, and we're just very excited to have this conversation today and hear John thoughts on where things stand. So for those of you who are not familiar with his work, John has spent more than 30 years talking about financial risk, financial markets, the economic backdrop. He's a thinker, he's a writer, he's a best-selling author. He hosts a very popular annual investing conference, and he's written a number of books. And he also has both a free and a premium financial content and newsletter service that we'd highly recommend the listeners to sign up for and to read, because it's very helpful across across all market cycles here. And so the conference, the SIC, is presently underway, and I believe that that you still can sign up and tune in. So we'd encourage everybody to check it out. But without any further ado, let's get into this conversation. John, thank you very much for joining us today.
It's good to be here. I think it's fun. I wish I was in Valencia with you, Ivan. I mean, really, I love Spain. I love the Gold Coast. I mean, one of the things about the whole pandemic and COVID, and God, I miss traveling, and I miss speaking, and I miss being with people. I will tell you that I don't miss trying to do dinner at 10 and 11 o'clock at night in Madrid. I had to beg my host can we at least go at 9 o'clock? Literally the entire restaurant was empty. There was this famous restaurant he was taking me to, yes, and it was completely empty. By the time we left at 11, it was completely packed. And same thing in Argentina. So I probably don't miss eating at midnight, but I do love the Spanish feel, the warmth, and I live in Puerto Rico now. So I'm in a Spanish culture. I'm trying to learn Spanish. It helps when everybody else speaks Spanish and you don't. But people ask me, how are you doing during the pandemic? And I said, well, it's tough to be stuck in paradise.
Yeah, absolutely.
It is paradise here in Puerto Rico.
Absolutely.
Yep. Yeah. Speaking of Spanish dinners, one of my favorite things is when the dinner wraps up at 12:30 or 1, and maybe the gin tonic cart comes around, and then everybody starts asking if you're going to go out for the night. So it's like, whereas most Americans are like, it's 1 a.m. I mean, I think we've been out. It's like, no. So are we going to go out tonight, or is this it? And I just love that. It's incredible.
I'm not going to say anything. I'm not going to say anything.
So the next meeting in Madrid, then it's settled. But as far as today's business, let's get started, because we have some ground to cover here. And so, John, you coined this phrase back, kind of coming out of the .com recession, this notion of a muddle through market, a muddle through economy, and I think that proved to be a very apt description of what was going on. I think recently you've kind of updated that to be almost more of a stumble through.
Yes.
Maybe to reflect kind of this maybe a new era of challenges or a new dynamic. So maybe if you could just start by kind of just filling us in on how we got to where we are today and what those phrases mean.
Let's rewind the Wayback Machine to 2000, 2001. And
perfect.
We'd had a real recession. Then we had 9/11, and which was an even bigger market sell-off. But we had debt beginning to get accumulate, and we were watching productivity fall. And at the end of the day, growth is the number of workers times productivity. It's just that simple. You can look at all these other inputs, but it's still the number of workers, productivity. And I looked into the future and I said, we will be lucky over the next 10 years if we do 2% a year on average for the decade of the aughts. And it turns out I was an optimist. We did 1.9%. So then we hit the Great Recession. We were coming to the aftermath of that. And I said, well, we'll probably do around 2% again, because we had an enormous quantitative easing and stimulus, and we had, kind of wrung out a lot of the excess in markets and so forth. And then we've just had a phenomenal bull run, and to the point today where valuations are high, we're at a place where in the U.S. economy, where we're getting ready to, unfortunately, begin to look like Europe, where your central bank stepped in and just bought everything that moved. That's what our central bank is doing. And our government doesn't even have the discipline of drunken Italians. I mean, dear gods, we are spending money. We've run up $6 trillion in excess debt. 25 to 30% of our total GDP we have spent and borrowed, and of that 6 trillion, the Federal Reserve has taken 4 trillion. And we're committing now the way we are, especially if we raise, we can unpack later some of the Biden plans, but some of those plans would be really not good for the future economy. So with all of this stimulus, and I think the inflationary stimulus is from the government, not from the Federal Reserve. I think we're going to have a decade where we stumble from, problem, and, Federal Reserve, government will try to pick things back up. Their impulses are good. They want to fix things, but they're fixing things in the wrong way. You don't fix markets. You let markets fix themselves. Okay? It's just, you get out of the way. We were already coming out of recession. We were already hiring at an enormous clip. And then the government said, well, we've got to fix the unemployment market. So they put in another, bunch of cash stimulus, which is okay. But then they put 6 months extra of unemployment, along with state unemployment, along with increased healthcare and food benefits, along with saying, well, you can't take anybody out of their apartment or their rent home, along with more and more. And so they're messing with the market. They're doing it with good intentions, but now we've got 8 million jobs available, and nobody wants to make the job because they're making more money. They've got to be making $18 an hour, $19 an hour to replace what they're getting from the government. And those, we're talking lower income workers. I get that, but they're not going to go back to work until September. It's just not into their advantage. And additionally, I know this anecdotally from my own children. Their friends are getting unemployment, they're getting these benefits, and then they're working in the cash economy. So they've got the best of both worlds. They're taking their government checks and they're putting it into the stock market. They're putting it into cryptocurrencies. It's just a different world out there. So I think we're going to have a decade of stumbles because governments keep wanting to interfere with the market, correcting itself. And that's just not how it's supposed to work. This huge debt that we are creating, and we are creating a debt, is going to do the same thing to us that it's done to Europe. And European central bankers would say, no, that's not the case. Absolutely not the case, but it does slow growth. Every piece of data that you look at, when it gets in the 80, 90, 100% range of debt to GDP, you now are starting to reduce growth. You're reducing the potential of growth. And we are already in the US at 120 to 130%. We're now at the place in the US where 7, 8 years ago, there were alarm bells ringing in Italy and Greece about their level of debt. And the United States, the world's reserve currency, is at that place. And we will be adding a minimum, even if none of the plans of Biden come through. Let's say that some miracle, a couple of senators that are, center left say, no, we can't do all these things. We're going to dial it back. Even if that were to happen, we at a minimum will be running $2 trillion of deficits for the rest of this decade. That's 10% of the US GDP. So in whatever country you're in, I mean, what's the GDP of Spain? I should know this. I should have looked it up, but I didn't.
I'm not sure exactly now. It's
I think 3 or 4, maybe 3 or 4 trillion. Is that right?
Exactly, something like that.
It would be like you running $400 billion worth of government deficits every year. And yeah, I mean, we're going to shove that into the market. Well, that's going to distort things. And the ECB is going to buy it. And it's going to slow growth. It slows that growth potential. And every economist, from the left to the right, from the Austrians to the neo-Keynesians, agree that the magic elixir, the cure for all diseases, is growth, is productivity. And and we're going to see a lot of technological productivity, but it's going to be difficult to translate that into service jobs. It's hard to make the bartender or the waitress or the hotel clerk more productive than they already are, unless you replace them with, robots and computers and so forth. Well, that's not good for the jobs. I mean, we are entering an era of rapid transformation. It's going to be challenging, to say the least. It's going to be exciting if you understand how these changes are happening, who's doing them, how can I invest in them, how do I get that piece of the puzzle into my portfolio. Look at Kathy Wood's ARC. Everybody talks about the ARC funds, and I know Kathy personally. She is and her team, they're some of the best, an analyst of actual future technology trends there is. Well, because she'd been so successful so long, these stocks have run up above value. She's now, from the first of the year, down something like 33, 34%. Yep. I mean, that's a big drop. And if people start pulling money out from her, then she's going to be forced to sell those stocks. It's going to force them to drive the price down anymore. It's like when George Gilder, and Ivan, you don't even know who George Gilder is, and you don't realize the impact he had on tech stocks and the dot-com era back in the 90s, and so I mean, he was the Kathy Wood, and he was the technology leader of that era.
Gilder Gagnon, yeah. Gilder Gagnon, and firsthand technology, and
I mean, but
there are a number of those. Funds. It's funny. A former colleague worked at one of those, and we
well, when Gilder talked about Qualcomm being the future, when he talked about Amazon being the future, he was absolutely right, but their stock prices got ahead of themselves. Is Qualcomm absolutely essential today? Is it one of the leading technology companies? Is Cisco one of the leading technology companies still? Well, absolutely, he was right. And when ARK Invest and those stocks drop 50%, we've got some Cathy Wood high conviction stocks in our, not a lot. We're just dipping our toe in my client portfolios. But at 50% the price of where they were 4 months ago, I start doing more than dipping my toe in. If it goes further down, I start saying it's time to buy with both hands, because Qualcomm, Microsoft, all those stocks back in the aughts, when they were down 70%, they were screaming buys because they're real companies with real value and real earnings potential. These are not flash in the pans. This is not pets.com. That's not what George was talking about. That's not what Kathy's talking about. So there's going to be some exciting themes, some exciting new technologies. At the same time, it's going to be, we've still got to figure out, as money managers, as businessmen, as the person that's supposed to be providing for our families and our children and our neighbors, how do we order our lives in order to make sure that our jobs are going to be there, to make sure that our income is going to be there? How do we make sure that we're spending less each month so that we're saving money? I mean, the normal things that a person should do won't change, but how we do it may change.
There's a thing, John, because what should be the response that the government should take? Response in fiscal and monetary and fiscal responses to this situation, if we want to kind of face the future differently, because this is happening in the States, but as you mentioned, it has happened in Europe, it happened in Japan, and actually Europe, we see it like a very big Japanization. And it's true that the States are also following the same path, but they are not quite in that point. So what are the fiscal and monetary responses, if they are some, to kind of steer the boat differently?
Okay, first of all, what we did right after the pandemic in the US, in Europe, was absolutely appropriate. I mean, dear gods, we had a pandemic. 40% of jobs just poofed. I mean, it was horrific. You have to lock down the economies. Let's go back to that time. Not very many people understood the nature of what was going on, and once they did, it was a shock. And the government appropriately, and by the way, it was a bipartisan effort under the Trump administration. Democrats and Republicans agreed, we've got to put money into the economy. It was appropriate to do so because we were in a hole. We had to help fill the hole so we could get out of it. Now, these latest rounds of stimulus are being passed by 1 vote in the Senate and 4 votes in the House. Slimmest majority in the entire history of the United States, and they're acting like they've got a 2/3 majority everywhere. And yes, Biden won by 8 million votes total, but those 8 million votes were stuck on the coast. If you change 40,000 votes, Trump wins. By the way, you go back to 2016, you change 40,000 votes, Hillary Clinton wins. It is that tight. A shift here and there, bad weather in Georgia. Lots of things can happen, and the vote shifts. And we have a problem in the United States in that we are just so politically divided, and we want different things, and we don't trust the other side. We We don't cooperate. The Reagan era, when Ronald Reagan from the right and Tip O'Neill from the far left would sit as two Irish descendants and just sitting, in the late evening, in the late afternoon, early evening, and would sit and talk about their families and drink a little scotch, and became friends and figured out how to work together. That's not happening today. I mean, you just can't. I can't see Kevin McCarthy from the House and John McConnell sitting down with Joe Biden and saying, "Let's have a little scotch. Let's maybe a good Spanish red." And by the way, I learned when I was in Spain that I learned how to buy Spanish wines. You just look for the wines. You find the ones that say Gran Reserva, and that's the one you buy.
That's the one.
All the others, you just buy the Gran Reservas. I've never had a Gran. That's what I do here in the U.S. If I look down the menu, I see a Gran Reserva. Forget all those other things. That's what I'm buying. So
that's right.
They're not going to sit around and drink that great Gran Reserva because they're not talking with each other. They're trying to shove their principles past each other, and that's not good because you get another administration in, you get another group in, it locks things up. There's no conversation. I mean, there's a movement in the United States to try to find a middle and to open it up, but we're at the beginning of those stages, and I think it's going to take a true crisis, way beyond what we had with the pandemic. It's going to take a financial crisis to get people to begin to cooperate, and that's not a good thing. I've been through a few financial crises in my career. I've been at it now 45, 50 years. Those are not fun to go through. But I think we'll be lucky in the U.S. to do 1 to 1.5% this decade. That will be lucky.
So John, that sounds decidedly not like the Roaring '20s. That has become such a popular narrative.
We have the exact
in pop culture. I don't know.
We have the exact opposite of what happened.
Yeah, I would agree. For what it's worth. Yeah.
I mean,
for what it's worth, I entirely agree with that.
I mean, what happened? You had what's called the Panic of 1920-21, and the president said, "We're not going to do anything. We're going to let the market clear it out," and they cleared out every piece of bad debt, every overhang. I mean, it was. They stripped it back to the walls, and then they rebuilt it. And that rebuilding process created the Roaring '20s because they had no overhang, no problems left. There was nothing but good in front of them. And they'd come off World War I. They'd come off this, terrible financial panic, and people were ready to party some. And it was a good period. That's not where we are today.
So what do you think it is? So what do you think it is in terms of, is the Fed so afraid of letting baby boomers are close to retiring, and they still have 65% exposure to stocks, and they're going to live longer, and they can't take a hit to their 401ks? I mean, is it that, yes, the United States is reaching European-like debt levels, but the United States doesn't have European-like Social Security net as it relates to public health care and kind of state pensions, and so we have in some respects, the United States is actually in a much worse position because we've spent all the money, but we don't have anything to show for it. And that, I lived in Spain for 3 years, and I benefited from from a very high quality, public healthcare system, and very high quality public education, and just a very high quality, frankly, of life in general. And in the United States, to me, being back here, it almost kind of underscores, how society is kind of on a razor's edge. You have wealthy have got, the wealthy have, done exceedingly well, over the last 18 months. But people who didn't have anything coming into this, have a couple stimulus checks to show for it. Whereas, homeowners and equity owners are doing, phenomenally well. But I wouldn't say that, frankly, anybody feels exceptionally comfortable, or exceptionally safe, and even, and I think it's playing out in the politics, where the people who quote unquote have resources, still, I don't think are in a position, they're still not very high up, Maslow's hierarchy, and I think perhaps that kind of creates, a lot of this tension, where there's a little bit of kind of, coveting, hoarding of resources, saying, well, hey, look, I work for this is mine, my future's uncertain too, and then there are people who, legitimately don't have much, and who are earning those, kind of minimum wage, those $15 an hour, who I think perhaps even more legitimately say, well, listen, if you don't think you're comfortable, try living in my shoes. And so I think, the Fed is seeing that, perhaps, and the Fed is talking about inequality, certainly, the Biden administration is talking about inequality. I mean, to be honest, arguably the Trump administration was very focused on inequality also, and a low unemployment. And so it's just, it's complicated, but it does seem like, one of the reasons why we're so far apart is because nobody is exceptionally comfortable with the current situation, and so how do you think that resolves? What is something you think that can be done? What does have that kind of Tip O'Neill, Ronald Reagan kind of bipartisan appeal that that we could move forward, and kind of unite around something? Or does it take a Cold War with China or something like that, to kind of get some cohesion and get some patriotism in the broad sense, not in a kind of a symbolic sense, but in a real kind of we're all rowing that same direction sense.
There's a lot of questions that you just had in there that let's unpack.
Sorry.
That's okay. Let's unpack the one about Federal Reserve. The Federal Reserve has two public mandates. One is for stable prices. The other is to, secondarily, was to, set the framework for full employment. The Federal Reserve has basically redefined what they think of as stable prices. They're saying 2.5%, 3% inflation. That's stable enough. It's an average. We're okay. I don't think anybody on the street, you walk up to them and say, are prices going up 3% every year? Is that stable? That's just not that's not going to be their definition. The Federal Reserve has said, we want to be involved in full employment. We're going to keep rates low until we get back to 4% unemployment. That's a nice goal, but you have to look at the United States has only been at that level twice in the last 70 years. Once was during the Vietnam War when we had 500 boys in Vietnam. So you took them out of the 500,000 boys, when you took them out of the workforce, and we got down to 3.9% unemployment. The other was at the end of 2019, the end of the Trump administration, where we had lowered taxes, we had pulled regulations back. We had our foot on the gas pedal. Rates were they weren't as low as they were, but they were relatively low. We were it was a good time, even though the economy was slowing. We have to remember this. The economy in 2019 was slowing down. We weren't going to do, we were looking at, do you call a recession in 2020? That was, that was a question that I was being asked.
The yield curve inversion certainly pointed to that, right?
And the Federal Reserve says, we want to get back now to that nirvana of 3.9%, 4% unemployment, and we're going to keep rates low. And I don't understand the causality. Somehow the low rates are supposed to cause employment. And I have trouble with that. Low rates cause speculation. Maybe it will help. I mean, right now, unemployment is caused to a great degree because we're paying people not to work. That stops in September. I don't think that's going to be allowed to extend. So people will start going back to work. We'll start seeing employment happen in the fourth quarter. That's just people do. One of the things that nearly all, I'm sure there's some idiot out there that doesn't agree, but nearly all economists agree that incentives matter. And if you give people an incentive not to work, well, shock. They're not going to work. So we'll see that change. And if we could just see that with, some actual infrastructure spending, as much as I don't want like debt, the U.S. infrastructure, I mean, we need to be working roads, bridges, water. I mean, we have some pretty old water systems in a lot of our cities. We need to figure out how to help finance those. We need to rework our grid system to make it a smart grid. We could probably save 10 to 15% of the power that we use just by making it a smart grid. It's $20 billion. I mean, I can't even imagine why we haven't done that 10 years ago. It's really, to me, it should seem obvious. We need some things like that. But under the Biden bill, daycare centers is part of what he calls infrastructure. And I don't, that's why it's going to be so controversial. Less than a third of what he's proposing as infrastructure is actually what classically you would think of as hammer and nails. We're building a system. The rest of it is progressive wish list. Not bad stuff. It's a good idea, but the Republicans are going to be saying, well, we can't raise taxes, we can't, and the Democrats say, well, we need to do this, it's the right thing to do. And both of them are missing the important question. The question we in the United States should have, the question that Europe is struggling with, but you've made your decision. You said, we want government to be this size. We want the government to do this, and this is how we're going to pay for it. And if you don't want to pay for it, then you either reduce the size of government or you increase the amount of taxes. I mean, that's just, and we're not ready in the United States to have that conversation yet. I will give Europe real kudos. You guys have decided this is the size of government that we want. And this is how we're going to pay for it. It has a cost in terms of potential growth, but it also has a benefit of a much more stable society, a society that gets along and quite frankly is fun. So, I mean, I love Europe. I mean, and I say Europe in general, I think I've been to every country west of Poland now. I've actually been to Ukraine, except Liechtenstein. No, not Liechtenstein. I've been to Liechtenstein, except, oh God, the little city-state.
Andorra?
Luxembourg or?
Have you been to Andorra?
Luxembourg.
And so I've actually said the next time I end up at Amsterdam or somewhere in that vicinity, I'm going to make sure that I've got a Sunday. I'm going to get on the train in the morning and I'm going to go have lunch in Luxembourg and then come back just so I can put another dot in there, because by that time I will have been to every country. But I find them all delightful. I find them all fun. I like going out into the countryside. So anyway, that's just, Europe has made their decision. We haven't made that decision in the US. And we're not asking that question. We're fighting whether we should raise taxes, and we're fighting about how much we should be spending for welfare and healthcare and so forth. And that's the wrong question. The question
I would argue, and I would argue that that the exorbitant privilege of the U.S. dollar as a reserve currency, and the Federal Reserve effectively monetizing our budgets and monetizing our debt, has made that question not have to be answered. You know what I mean? And to me, all that's doing is, but it does eventually have to be answered. And I think what we're doing is we're kind of kicking those hard conversations down the road at, I would argue, an increasingly high and increasingly unsustainable. I think we're going to call it. Is this the halftime here of the first interview, and then we'll pick it up in a minute? Is that right?
We can come back for part two anytime you guys want to.
I have, John, a last question for this first part interview, and it's how are you investing today? I mean, you have talked a lot about a lot of things that all of them take an important part in the portfolio construction. If you take into account the technological thing, if you take into account the growth that you expect, I mean, there are many things that then, if you put all together in a portfolio, what would be that kind of portfolio? What are you investing today, and what are some of the opportunities that you see?
Well, today, I'll tell you exactly what we're doing for clients. We create two buckets. One is an 80% bucket that we call our core investments. And we want that 80% over 4 or 5 years to grow back to the 100%. So it's not a very aggressive project. There's very few, small portion of that's a long only, and that's in high dividend growth stocks. The rest of it is in trading strategies. I think the way we diversify is trading strategies. We have a lot of private credit. The bond market's broken. Totally. 1.5%, 2%, 4% for high yield bonds that are going to default by 7 to 8% historically. That's a stupid bet. We don't want to do that. You can go into the private credit market. Now, you couldn't do this 5 years ago. I mean, it was tough. You could. It's a lot easier today. The technology has improved to the status point that we can grab it. We know where to find it. I have a lot of resources and friends, and I can give investors high single digits, low double digit returns in what you would want to call a corporate grade debt. I'll give you an example, since this is going in Spanish and it'd be difficult for you to access. In the US, we build cell towers, just like you build cell towers in, for 5G you're rolling out. That cell tower has to be paid for, has to go on the side of a building, and the AT&T and T-Mobile and so forth really don't want to spend their money buying cell towers. So there's a whole industry that will go out and build cell towers for them, put their capital into it. There's several groups that do. There's a public company that does it, and they go out and they'll put you give them their money, and they're going to pay you 6% a year for 2 to 3 years. and they're going to buy one cell tower after another, $1,000 here, $5,000 there, depends on how big it is and where it is and what it costs. And when they get enough of them, they package them together and they take them to BlackRock or Apollo or one of the big guys, and they want the income. It's a pure income play. They just buy it, boom. And so they're getting that. And when they buy it for a premium. And so the investor is probably going to get another 3, 4, 5, 7% at the end of those 3 years. So his internal rate of return now is high single digits, sometimes low double digits. It just depends on what the market is that day. There was a time 8 or 9 years ago when you could get, mid-teens. That world has gone away. It doesn't exist anymore. But who's your credit risk? It's AT&T, it's T-Mobile, it's Sprint. That's rated credit, but it's private credit, and it's a private company that puts it together. And there's some risk, but they've done almost 20 of these packages now. We know what it's. We have experience, and you can ladder into it. So you can have you put some in this year, you put some in next year. So you've always got something that's like a 2 or 3 year ladder. There's lots of things like that. So if people ask me, well, it's the only game in town is buying stocks and bonds, and I'm going, no, it's not. There are a lot of other games. I'm not going to play in that ballpark. I don't even want to play that game. So I don't buy equities in the traditional sense. I buy trading strategies. And we get people who are hedge fund managers, who are ETF traders. We get different people that it's not that they have no risk. They do. Market goes down 40%. They're going to go down something, 10, 15, 20, depending on the strategy. But they're not going to go down 40 or 50. And so I've reduced my volatility. Now I'm reducing the gain that I'm making. In a bull market, I'm always going to lag. In a bear market, I'm going to look like a genius. I think for the stumble through decade of the 20s, I'd rather I want to control my volatility. Okay. I don't want to ever have to call up somebody on the phone and says, you're down 50%, but don't worry.
It stands to reason.
I don't want to do that. Bonds used to be what you put into your portfolio to balance your risk. Well, now if interest rates go up, the value of the bond goes down. Bonds no longer are your risk hedge. They may be the risk themselves. So I do cash flow strategies. We don't want to call it fixed income, just a cash flow strategy. And we take the traditional portion that you'd put into a portfolio as cash flow strategies. There's lots of things you can do in a portfolio without getting into the traditional 60-40 traditional money manager things. I just think that's silly. But it's the easy button if you're an investment advisor. And if the market goes down, you say, it's just the market. It's not my fault. Our strategy, here's our models that we've got going back. And, look, just trust us. No, I don't want to do that. Never want to be in that game. Now, we take the other 20% bucket, and that's what we call our explorer bucket. And those I'm not trying to do, 7-8% compound return over time on that bucket. I'm trying to do, 3 times, 5 times, 10 times. I'm trying, that's, and you spread that out over, you don't put it into one portion of that stock, of that explore button. You spread it out over opportunities, because that's where we look at where the the technology, that when I talk about being long humanity, I'm really bullish about the future of humanity. I'll tell you something Europe just did brilliantly and finally, you have
what is it?
You have approved a new, and you're in the process, but you've announced it. You're approving a new process for seeds and agricultural technology that is non-GMO. It's basically just, they say it's a biologically identical to the original seed. It's just teaching the seed to evolve. So you're going to be able to get canola, for instance, that will be herbicide resistant. So you won't have to use herbicides in the field. You can get it fungicide resistant, disease resistant. So you don't have to put fungicides on it. You can make it where it'll absorb more nitrogen for the soil, so you're not using as much fertilizer, water, drought resistant. You can evolve a seed to do all of these things. And Europe has 250 million acres that is desperate, because you've said we're not going to use GMO, which is the rest of the world's doing. And that's your choice, but that's the choice you've made. Well, now you're going to get a technology that has all the benefits without any of the, seed altering, the virus altering, the DNA altering, genetic modification. That's going to make your agricultural section far more productive. I mean, it's going to be a revolution over the next 7, 8, 9 years in corn and wheat and soybeans. You can make gluten-free wheat.
Yeah.
You can have peanuts that will not be allergenic. I mean, there's so many things, and that's something that Europe has just announced like 3 weeks ago. That technology is coming to you, and that's it'll be public sometime later this summer, but it's still in a private format. And you're getting private market valuations opposed to public market valuations.
It's interesting, John, because here in Europe, we happen to think that we don't have these kind of big companies leading you guys there in the States, you have Apple, you have Facebook, you have Microsoft, these kind of enormous companies that are leading the big breakthrough in technology, for example. Of course, this is another area. It's the agricultural area. Actually, it's super nice because it touched me, because we have a company, we bought a company that is investing in this field, actually, by using also artificial intelligence. So it's one of the projects is that, and it's super excited. But it's true also that in Europe, we don't happen to feel this, that like we miss the capability of growing an enormous company and lead the technological breakthrough. And this is something that is in there. You are doing, Americans are doing really exceptional, but it's also nice to hear that there's this area where we can kind of stand up, so it's nice to hear, actually.
Well, I mean,
I didn't know, actually.
In our book, in our network, we find stuff like this. That's just part of my life. And it gives you the opportunity to have an outsized return in that 20% explore part of your portfolio. So if you asked me how I manage money, there's a lot of details and years and things in that, but that's the philosophy. And because I want to protect my core, and I want to take advantage of what I think is going to be a fabulous technological boom in the next decade. I mean, it's just we had Joe Lonsdale, who was the co-founder of Palantir with Peter Thiel, that was at my conference that I interviewed him last Friday. Powerful. God, his vision. I mean, you just want to say, can you take my money, please? Well,
this is what I'm getting now.
He's done it with dozens of companies. You have, and by the way, he's moved to Texas. He said, I can't take Silicon Valley anymore. He moved to Texas along with Elon Musk. There's a lot of the Silicon Valley that are just, they're looking for places where they can have, they're a little bit more freedom of expression. And with Zoom, with technology today, you don't have to be in Silicon Valley anymore. And I mean, I think you just have to have visionaries who are willing to jump out there. You have to have willing angel investors to start, and then venture capital. I mean, it's just in the United States, we've had the fortune of being able to build an ecosystem that supports these guys.
Totally. Okay, let's.
So I've run completely over my list.
No, it's awesome. So, but I want to cut you off because I want to leave some of these responses to the next interview. So if you don't mind, let's stop here. So thanks a lot, John. It's been an honor to have you in this first part of the interview. And now I'm feeling like the very same thing that you have said, that I would like to put all my money on you. So thanks a lot, man. It's really it's really motivated. This I love it. So thanks a lot. And I think we're gonna keep going with the next interview.
I'm going to switch to Spanish to tell the users, to our audience, that we thank them for tuning in. It's really a pleasure to listen to people like John, to share with us their know-how, share their experience. Please remember that if you like this kind of interviews, give us a like, subscribe to our channel so that we can work on it.